The MPC decided by a majority of 5 members out of 6 to increase the policy repo rate by 35 basis points to 6.25% with immediate effect. Now, I think this is one occasion where the market expectations and the decisions of the Monetary Policy Committee are by and large aligned, and there are several interpretations whether when the market expectation and the monetary policy decisions are aligned, whether they are they have to be taken as a perfect monetary policy or otherwise, but that debate can happen some other time. Now, consequent to this increase in the policy repo rate by 35 basis points, the standing deposit facility, that is the SDF rate, stands adjusted to 6% and the marginal standing facility rate and the bank rate to 6.5%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now elaborate on the MPC's rationale behind these decisions relating to the policy rate and the stance of the monetary policy. Growth prospects across the world are dampening. Financial markets remain nervous and are characterized by high volatility and price swings. For the Indian economy, the outlook is supported by good progress of Rabi sowing, sustained urban demand, improving rural demand, a pickup in manufacturing, rebound in services and robust credit expansion.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Market Today. The worst of inflation is behind us, says the RBI, but warns no room for being complacent. The RBI hikes the repo rate by 35 basis points, taking the benchmark lending rate to 6.25%, making it the RBI's 5th straight increase in lending rates in this year itself. RBI has also lowered India's GDP growth forecast for the current financial year to 6.8%, a marginal reduction from 7%, and this after the World Bank upgraded India's growth forecast to 6.9%. Joining us now, Indranil Pan, the Chief Economist at Yes Bank. Welcome to the show. Your first key takeaways in terms of the highlight of what you heard from the RBI. A 35 basis points hike was more or less penciled in. In fact, a BTTV poll had a majority of respondents hoping for a 25 basis points hike, and just 20% of the respondents had expected a 35 basis points hike, Indranil.
Yeah, so I think you have bulletized it quite well, any which ways, that inflation, the peak of it is beyond us. But we continue to need to be very cautious about how inflation pans out from here on. So 2 things are highlighted by the governor. One is the food prices. The food prices, definitely there is a seasonal effect in terms of the vegetables, and therefore the food inflation for the next reading could be lower, and inflation overall, the headline number could also be lower. Having said that, however, he points out that there are certain elements within the food also, which is specifically the cereals, which is the milk, etc., which continues to remain or see an upside. In one section, he also points out the weather changes globally and therefore the uncertainty with respect to food. But I think the more important take for me is how the RBI once again is willing to look at the core inflation and is indicating that there is a rather sustenance of core inflation, and hence there is a need for the RBI to maintain a stance of removing accommodation of monetary policy. I personally was hoping for a 50 in this policy. I understand that a lot of the market, or a majority of the market, was at a 25 to 35. And one of the critical reasons I was hoping for a 50 is I was not really, from my own estimates, seeing inflation coming below the 6% level before February. Data that RBI would see sitting in March. and therefore the 35 basis points, in my opinion, increases the risk of a slightly longer rate hiking cycle than what was being earlier anticipated.
That's a good point. So for the average person, does it mean that you yourself feel that another hike is likely, perhaps after the budget, once the policy side of moves has been factored in by the RBI? Because one of the other statements that I recall was the governor saying that inflation will remain above the 4% target for at least 12 months, Indranil.
Yeah. So yes, we are expecting a 25 basis points hike in February. And to us at this point in time, another 25 basis points increase in April is maybe not 100% probability, but the probability is not very low. And there is a realistic probability that another 25 basis points therefore happens in April. Now, if I read the policy very carefully and pass through the words, I think clearly it indicates that the 6% threshold is likely to stay for some time, at least in this financial year. And therefore, the Q4 estimate is a 5.9%. Now, given the significant amount of uncertainties that we are experiencing in terms of the supply momentum, the opening up, on the other side, China is opening up. Some of the critical metal prices, even though oil is on the downside, aluminum and copper have once again moved to the higher side. So there are lots of moving pieces at this point in time. And hence the certainty with which you expect inflation to come down may actually be a question. The other important point that the RBI points out in H1, inflation is likely to be lower than the upper threshold of 6%, but they do clarify it by saying that it will still be higher than the target rate. So once the inflation comes down below 6%, the sense that I am getting is that RBI immediately will change focus towards the target rate, which is more like a 4% rather than the band that the RBI had been playing. Saying that it is a flexible inflation band and all the monetary policy actions therefore.
Would it be fair to interpret at a sort of broader level the RBI's actions over the past 2 years with regard to monetary policy as the following? That during times of extraordinary economic stress by COVID and the kind of more accommodative stance that was taken, the RBI interpreted the 2%, 4 to 6% mandate in a very relaxed fashion. And now that there is greater certainty, we are out of COVID and its economic impact largely, the RBI is now being strict with regard to interpreting its mandate for inflation.
Well, I think obviously there has been a bit of a changing goalpost. But looking at the context, I think inflation was ruling significantly higher than the corridor in terms of the inflation mandate that the RBI was supposed to operate on. And to that extent, all the justification that we have seen in terms of the monetary policy action of a 50, which is obviously on the relatively larger side so far as India is concerned. Now, I think what the RBI through this policy is trying to also clearly indicate that they have to be very confident that second round implications of inflation do not filter through in the economy. And by doing that, they are trying to therefore signal that if they are able to contain inflation and the second round pass-through of inflation, that will probably set into motion a relatively more sustainable growth path than what we are sort of envisaging at this point in time. And relative risks in terms of financial stability, stroke instability will relatively be lower. So that is, in my opinion, the guiding post for the RBI at this point in time. And one of the elements definitely is to have a very critical handle on inflation and to sort of bring down the inflation expectations to as much possible and therefore set in motion a more sustainable growth path wherever it is, whether it is 6.5 or whether it is 7. I think that's not the very relevant issue at this point in time. The more relevant issue to me is to have a more stable atmosphere, a more certain atmosphere, which will also enable the private sector investments to come through. Because the uncertain atmosphere, in my opinion, even though we have consistently talked about the capacity utilizations having been high, the balance sheets of the corporates relatively clean, to enable them to sort of push forward their investments, the uncertainty continues with respect to the global perspectives of demand as well as the domestic perspective. And unless we have a very clear handle on that, it's very difficult for investments on the private sector to come through.
What's your own outlook on inflation for the next 6 months till May, June, at least 2 quarters? And I ask you this question with the backdrop of the point on second round pass-through that you made. One of the key pass-throughs that has been prevented by the government from happening is on petrol and diesel. For the last 6-7 months, whatever volatility has been seen in crude oil has not been passed on at some cost to the oil companies and the general budget. And now crude oil is trending below $80. Therefore, keeping that into account, what do you expect is the likely course for inflation in the next 2 quarters?
Rightly said that crude at this point in time doesn't affect my retail inflation simply because there is no pass-through. Somewhere, I think the government will also have to take a very significant view in terms of when they can or may not be willing to do the pass-through, simply because, as you said, it's more an implication for the fiscal than anything else. So in this context, to a certain extent, it's not only the oil, but the oil derivatives that also push up the manufacturing inflation. And this is a pass-through that even the governor has talked about, that most of the companies had been facing higher input cost, and 100% pass-through has not really happened. So here, I think we have to be very clear about, you just mentioned about the petrol and diesel. Yes, that is, those prices are being held, but the government is not holding the pass-through of any other item that may be either related to the energy side of the story or any derivative of the oil economy, for example, soap production and etc. So some of these elements, therefore, we talk about as the second round effect, and therefore we need to have a clear handle on that.
On a slightly different context, I want your views on the Pradhan Mantri Anna Kalyan Yojana, which is had a significant fiscal impact. There is a decision that is coming up in the next couple of weeks, because that scheme has been extended till December, and we'll have to see whether it will be extended beyond that point. Has that impacted inflation in any manner? Would you have any comment on that?
I wouldn't say that has impacted inflation. In fact, to a certain extent, it would have enabled you to press down inflation, because there was a pass-through of the food from the supply side, and that to a certain extent enabled inflation to be relatively lower. That definitely has a lot of connotation in terms of the fiscal, which is basically the food subsidies going higher. But going forward, we have to be very careful as to how to take this policy forward, simply because we have seen wheat sort of surplus stock at the FCI having watered down significantly. The procurement of rice and paddy has moved along smoothly till this point in time. So that is another thing to consider. We are more or less at the buffer level so far as the rice and the paddy is concerned. But let us not forget that the government also needs to build back some of the surplus stocks they have lost, simply because we have a clear uncertainty in terms of weather conditions globally. The food prices, therefore, globally could be quite volatile going forward. And that's the critical risk that we are talking of.
We've spoken about inflation, and before I move to understand the demand side impact on you, just one more point that remains as far as inflation is concerned. In your expectation, because there is a lag, although transmission mechanisms have been improved, what has been the impact of these hikes cumulatively since May this year as far as growth is concerned? What's your own sense about it?
Well, it's a slightly sort of convoluted story, in my opinion, at this point in time. The latest GDP numbers that came out, to a certain extent, I can build in some amount of festive demand into it. But if I look at the personal consumption expenditure, that has, on a quarter-on-quarter, non-seasonally adjusted basis, has gone up just by about 1% compared to the previous quarter. The previous quarter, on the other hand, was 2.4% lower than the fourth quarter of the previous financial year. So that's something that we need to sort of track going forward in terms of trying to determine what is the strength of the economy and how much inflation is affecting the economy. Very clearly, I think the rural segment is a problem in the sense that most of our farmers are subsistence farmers, and even though the food plate prices were higher, a lot may not be actually translating back into the farmer's income growing. So that's I think another relevant factor to understand in terms of trying to determine what is the growth dynamics from a demand perspective is. So I think we will see or continue to see a relative K-shaped recovery. With the rural segment continuing to suffer, even as the governor talks about the output and the procurement being on the higher side, relative stability on the urban side, and that's the way we have to move forward.
Your own views on the demand impact, and while I'm not asking you to talk about home loans, I'll request my producers to bring up that bit of data on the screen. What kind of impact do you foresee? In the last few months, we have seen two anecdotal sort of events play out. One, we have seen some impact on the vehicle segment as far as two-wheelers are concerned. In the housing space, we continue to see the premium luxury housing continue to fire even before Diwali and afterwards, if you take advertisements as one of the parameters. However, affordable housing is not spoken about. In fact, there is perhaps not a single launch that I am aware of in the recent past, and I could be wrong. Therefore, is this rate hike cycle also dampening demand on those fronts?
Well, I think the perspective that you brought out is going back to the K-shaped recovery and the unequal distribution of income. So while I would associate the example of the two-wheelers to more the rural demand, which is therefore soft, the upper strata of the society, the top 10% of the society may still have significant amount of money to spend, irrespective of the rate hiking cycle and the incremental EMI burden that they will sort of need to take. Having said that, I think we need to also understand the fact that on one side, your stamp duties are sort of being lowered. So that's a push to the housing sector, more the premium sector housing that you talked about. And on the other hand, that to a certain extent balances the higher EMI outgo. But more importantly, it's a cycle. Interest rates are always a cycle. And yes, you are having to take a higher EMI today. But on a cyclical basis, maybe 1 year down the line, or maybe even 18 months down the line, the cycle possibly needs to change also. And that is the point in time when, given the fact that a housing loan is typically a 15 to 20-year loan, you will get a benefit. So the consumers will get a benefit of lower rates in days and years ahead, rather than just looking at it from the current perspective. But very clearly, I think your two examples that you gave indicates the K-shaped unequal distribution in terms of the growth parameters as is panning out in India.
One final quick comment. What is it that you had expected to hear from the RBI, from the governor, but wasn't there, which kind of is something that you would like to mention?
Very honestly, our own expectation was a 50 basis points, while the street expectation was a 35. The reason why we expected a 50 is that the labor markets in US are strong again. If you look at the wage increases that have happened as per the last data, the confidence in terms of the US Fed, even if they do a 50 the next time, to bring their interest rate hiking cycle to a halt, that is slightly questionable in my mind, and therefore the hiking cycle may be more extended in the US, and hence I did talk about the hiking cycle in India to be more extended. What a 50 could have done, in my opinion, however, is to bring ahead the intended hiking cycle, and the pause could have been seen earlier, which could have established a more certain atmosphere in terms of the businesses being able to take the right decisions. So that I think I was expecting to see, which did not happen. Probably the RBI lent towards the market bias of a 50 basis points in the US, and also to a certain extent at the margin, getting a little bit worried on the growth, with themselves having brought down the growth estimate to a 6.8 from a 7%.
Absolutely, and the key headline, as Indranil Pan, the chief economist of Yes Bank, has told us, viewers, is in his own expectations, the rate hike possibilities have been extended into at least the next few months of the new year, with 25 basis points being penciled in by him at this stage in February, and possibly another 25 basis points in April. We'll see whether that happens, but for now, Indranil, thank you very much for your time with us today on the show. It's a wrap on this. We'll be back with more. Stay with us.
Thank you.
When you see businessmen with this almost a crude kind of display of wealth, building huge mansions, buying ships and yachts, and this public display of